I've sacked my financial advisor. How do I run my portfolio? Well, that's a very good question because most people want to take control of their investments so they've got greater understanding of what's going on and what they can achieve in the future with their money. In this real-life case study, the investor has over 50 funds and he's paying over £47,000 a year in management fees, including platform fees, fund fees, and fees to his advisor. And this shows the hidden costs of using a financial advisor. It's not just about the 1%. There's all kinds of other charges on top, including setup fees and exit fees and VAT. In our real life example, our investor is 72, 2.4 million in a SIP, 260,000 in ISAs, 1.8 million of property, and he wants to simplify his portfolio and generate 5% growth a year. But his Achilles heel is that he's only prepared to stomach a 10% loss in any given year. And this is what's really holding him back. This is what's causing him to invest in so many different funds and some very poorly performing funds in order to allegedly have capital preservation, when actually protecting your assets is quite difficult to do because stock market crashes and corrections are caused by a whole host of factors. History tends not to repeat itself, and so it's very difficult when looking at what will have done well in the past to actually say, yes, that will do well in the future when interest rates rise from 0.5% to 5%, for example. Don't be put off by the size of the portfolio. It's really the principles that are important here. So here is the portfolio, starting off with the largest holdings. There's bonds in there, there's gold in there, there's some value funds in there as well. There's infrastructure and a few individual companies such as Microsoft. But the list just goes on, and there's a lot of really pointless duplication and a large tail end to the fund. So the issue is going to be, how do you decumulate this? How do you know what to sell? So the Investors Chronicle have tried to simplify the holdings, and we've got S&P 500 at number 1, which is looking a bit better. Then we've got quite a lot of bonds, which is maybe okay if you're older and want to be a bit more defensive. Then we've got a global tracker, and then some dividend aristocrats. We've got gold in there and some defensive funds like Trojan and Ruffer, but there is some unnecessary number of holdings because you don't really need a Europe fund, an S&P 500 and a global tracker. You could just put more in the global tracker and just drop the regional funds, which don't really add anything to the portfolio unless you have a specific strategy around how you're going to play the US as a region, how you're going to buy it and sell it over time. And again, we've got a bit too much of a tail end to the portfolio and some real dogs in there like Digital 9 infrastructure, which just doesn't have a track record at all. So how can we get a 5% nominal return without having a drawdown of more than 10%? Well, one way to do it would be to buy some UK government bonds known as Gilts. If you get some short duration ones, you can achieve a return of just about 5% on those at the moment with interest rates where they are, but that does leave a problem as to what are you going to do when these gilts mature and what might interest rates be then. So you could put together something like Ray Dalio's all-weather portfolio, but this does have a massive allocation to long-term 20-year plus bonds, and his original version of course has US bonds, and you'd probably want to have UK government bonds instead, or at least hedged US government bonds to take out the currency risk. So here's the drawdown of the all-weather portfolio, and it did pretty well during COVID, no real problems there. Not quite sure what this is. It's probably something to do with bonds and interest rates. Global financial crisis did pretty well then, but more recently it's had quite a horrible drawdown of about 17%, and that would have been quite painful for anyone holding the all-weather portfolio. So although it is marketed as being defensive, there is no guarantee that the drawdown will come within your parameters. So you've got to be careful when putting together such a portfolio, and what you might want to do instead is maybe rebalance some of the bonds and maybe have more short-term bonds instead of the longer term, and that might give you some greater protection in terms of interest rate changes. So you could invest some, but clearly not all of your money, in a fund like this Man GLG Alpha Select Alternative, which takes a long and short position on basically FTSE 100 equities. And by doing that, it's trying to go long the strongest shares in a given sector and then offset that by going short the weakest share within that sector. And this largely nets out, but it tends to deliver a small positive gain with consistency. And what we can see is that each year it has delivered positive returns. During COVID, it actually had a spike upwards because of its short position that it was able to make gains from. So here we have a price chart comparing the WisdomTree Global Quality Dividend Growth ETF to a global tracker. And what you can see is that the WisdomTree Global Quality Dividend Growth has lower drawdowns, particularly in things like 2022. So although potentially the growth might be lower, I'd argue that the WisdomTree fund is less volatile and might be more suitable for someone older who wants to have a bit more of a margin of safety in their equity investments. But of course, the best thing to do around the pain of drawdowns is to very carefully structure and segment your portfolio. So you've got to look at what you need to withdraw in the coming years. So you've got what you need in 0 to 3 years, where you need this capital certainty. That's where you can have the short-term government bonds or the money market, and you won't get a 10% drawdown on those funds. So you can be very safe in the knowledge that whatever happens, the next 3 years of your life, you've got the money delivering returns for you. Then you put some of your funds into the 4 to 10 year bucket, where you still want this lower volatility. You want a margin of safety in terms of what's going on. And for this, something like the WisdomTree Global Quality Dividend Growth is an excellent fund because it's screening the largest companies in the world for the payment of a dividend and a strong balance sheet and decent margins, and that way it excludes some of the more flaky companies that either don't pay a dividend or pay just a really tiny dividend, and they get a very small weighting within that fund. And so the ratio of price growth to price volatility is pretty favorable amongst the WisdomTree Global Quality Dividend Growth. And then for the longer term, well, here you're potentially not really concerned at all. If you've got over 2 million in assets and you're in your 70s, you're probably not going to spend all of it. So really, what are you worried about? And you could experiment with some themes or some countries that you're quite interested in. You might think there's a lot of economic growth in India, or you might think that artificial intelligence is going to completely rule the world, and you can put some money there, small amounts of money, and then see if it grows and give it a longer time frame to fully mature and to fully deliver the sorts of returns that you require. Or you don't even have to do that at all. You could still have something like a global equity tracker within this long-term bucket, and then you could stomach drawdowns that are either quite steep or that last quite a long time, because you don't need to access this money for 10 years or more. So the approach to drawdowns is to, rather than find some funds that are promising lower volatility, although they can't guarantee anything, or to try and find a financial advisor who says, oh, I can help you manage your investment risk, just pay me £47,000 a year and I'll sort it all out for you. Instead, if you just reconceptualize how you're going to access your money, then you can sleep much more soundly. You can invest in much more transparent investment vehicles and still get the returns that you require from your portfolio, and you won't be so concerned with the overall noise in the market, the overall inevitability of prices fluctuating up and down. So there's essentially three approaches to investing. One is to do it yourself, and you will be required to educate yourself correctly, which would mean reading books like this Smarter Investing by Tim Hale, which has got very good reviews. It's now in its 4th edition. It's very well respected, and that will help you understand asset classes and risks and how to structure a portfolio. You could see a financial advisor, but they're incredibly expensive, and as there are no magic funds, I have to question the value add of a financial advisor, and some actually can detract value by overly complicating your portfolio, putting yourself into all kinds of different funds that end up completely underperforming. And then the third choice is to use a coach to work alongside you as a sounding board. Again, you will have to educate yourself because the coach cannot give advice. They can only help to steer you in the right direction. But coaches have very transparent pricing. You're always in control, and it's a good balance between investing on your own and not being 100% confident in what's going on, and having someone else help you to realize your investment objectives. I'm Ian Shadrack, an accountant with over 30 years experience. I help people build portfolios for a resilient and successful retirement. And here's something else that might be of consideration. It's JP Morgan Global Equity Premium Income ETF. And what we can see is that the price is pretty stable over time, and it doesn't seem to have had much of a price decline in late July, early August, unlike the global tracker. And possibly by focusing more on income, you also get the added bonus of more resilient prices and lower drawdowns and less prolonged drawdowns. However, this fund has only been in existence for about 6 to 9 months, so it would be useful just to see how it performs in the future before buying it. I do like JP Morgan. I think they are one of the better investment houses, and this is actually an active ETF, so there are actually people picking which funds meet the criteria to go into the overall ETF. And here we can see the top 10 holdings of the JP Morgan Global Equity Premium Income ETF. So none of them are over 2%, so it's quite well diversified. US still quite a large holding, 60%. Japan overweight, 10.5%. Sectors, technology number 1, but not as to the extent as a global tracker. Then we've got healthcare and financials. So yeah, it's looking quite interesting. Fees are 0.35%. Dividends are paid monthly, and this is a distributing ETF, and the yield is around about 6%. So it looks like it's one of the better global income ETFs, and I'll include it in my quarterly income portfolio review. So my conclusion would be to always try to simplify and streamline your portfolio as much as you can so you can really see what's going on. Map the funds that you have into these time buckets so that you know when you might access the funds and the kind of risk profile that you are able to tolerate. And always look for low fees, because it's such a drag on portfolio performance, whether that's the fee of the fund, whether that's using a financial advisor or not, or whether that is the platform fee. And particularly if we have lower growth from equities in the next, say, 10 years, then managing your investments yourself and trying to cut out unnecessary fees is probably the way to go. If you're interested in putting together a portfolio for your retirement and in wealth planning, go to my website, ianshadrack.com, and you can contact me there or sign up for my newsletter and get free files and research updates.